All right, it is 7 o'clock. We're going to go ahead and get started. Welcome, everyone, to tonight's presentation. My name is John Mantilla. I'm the Director of Finance, one of the co-founders here at Parco, and I'm joined tonight also by my colleague Quinn Ackerman and Daniel Hampel. Um, they'll be helping with the question and answer section of tonight's presentation. As always, it's really great to have them on. Quinn in particular was very helpful in creating this entire presentation for us. So we're really appreciative of her being on the line tonight. I do see a lot of new faces and new names. Welcome, and I do see a lot of familiar faces as well and familiar names. Welcome back. Uh, for those of you who are new, we are Parco. Parco stands for Pensioned Americans Retirement Company, and we do retirement and financial planning for anybody with a pension, in particular federal employees. As a team, we spend our time speaking with clients who work for the federal government or who are retired from the federal government, no matter what part of their careers that they're in. Sometimes we speak to people who are just starting out uh, and help them get positioned, and they have questions about how to make sure that they're positioned properly and that they're doing all the right things at the beginning of their career to make the most of their service with the federal government. Sometimes we're speaking with people who are in the middle of their careers and want to make sure that they're on the right path for their future goals. And then oftentimes we're speaking with people who are nearing the end of their careers or who are already retired and want to make sure that they've prepared themselves well for the next big step they have ahead. No matter what stage a person is in their career or their position, we help everybody that we talk to. Now, some of you may have seen us featured in a bunch of different publications, like the Wall Street Journal, U.S. News and World Reports, Forbes. Our name's getting out there, and people are starting to respond really well to the things that we have to say. Some of the things we're really proud of. So for those of you who are new, a couple things about these webinars. We do them every Wednesday night with an encore presentation the following week. So we do a new webinar basically every 2 weeks. Our goal for these webinars is to keep them to between about 20 to 30 minutes. We find that that's about the amount of time that we can keep somebody's attention. And that's still enough time that allows us to go deep into a topic that's of interest to our client base, our federal employees and retirees. So a couple ground rules. You'll have the opportunity to ask questions at any time you like within the Zoom window here at the top. There's the Q&A section. So if you do have a question throughout the presentation, please ask it there. We'll also be hanging around after the presentation to answer any questions that you have afterwards. We stay to make sure everybody's questions get answered. And then after tonight's presentation, everybody who's on tonight was going to receive a survey asking for your feedback, both good and bad. If there's things you think we did well, tell us. We love to hear, that we did a good job. If there's things you think we could have improved on, let us know that too. We're always looking for ways to improve because we talk to so many people every week. Another thing that we'll ask is if there is a topic that you want us to talk about in the future, please let us know. The idea for tonight's webinar and many of the webinars we've been doing over the past few months have been because of the feedback that you've given us. And actually, when I think about it, this may be our 52nd webinar that we've done. So this might be our 1-year anniversary of doing these webinars. So it's been a whole year of topics. So anyway, with all those formalities out of the way, let's talk about tonight's topic. So this is basically the second presentation in our 3-part series covering some investment topics. And tonight we're doing a deeper dive into the G fund, analyzing the largest fund within the TSP. And something that we get asked a lot of questions about, especially given things that are happening in the markets now, especially as people get closer to retirement. We see a lot of clients asking about the G fund. So a couple disclaimers, because tonight we are going to be talking about investments and performance. Past performance is not indicative of future results. Everything that we're presenting tonight is based on the historical data from the G fund or any of the investments that we talk about. And we're not making any claims about future market performance, and all of the analysis is based on historic data. So with some of those disclaimers out of the way, let's go through tonight's agenda. So first, we'll talk about some of the basics of the G fund, its size, its history, how it works, and then we're going to transition into it and talk about how the G fund works. We've heard a lot of hearsay about people saying, "Oh, well, it's a bank account. Oh, well, the government can borrow from it. Oh, I get the 5-year Treasury rate." We're going to explain exactly how the G fund works. Then we'll talk about how investments in securities and investment allocations like the G fund, conservative assets, uh, how that impacts investors, especially given the current environment of interest rates and now with more and more people being concerned about inflation. And then we'll talk about the stages of investing and financial planning and considering alternatives to G funds that to the G fund that many investors and many of our clients look at. So now let's talk about the G fund, its size and its history. So as a refresher, I know we've spoken about this before on past webinars, but within the TSP, there's 5 core fund options. There's the G fund, which is the government bond fund, the government securities fund. There's the F fund, which follows corporate bonds. There's the C fund, which follows the S&P 500. The S fund, which follows small cap stocks and the Dow Jones Small Cap Completion Index. And then the I fund, which tracks international funds. It follows the MSCI EAFE Index. And then there's your life cycle funds. We'll be covering life cycle funds in more detail in a future webinar, but a lot of people don't realize that the life cycle funds are just a different mix of these 5 TSP core funds. Now, when it comes to the size of the different TSP funds and how much assets are in each of them, well, as of the end of 2020, the G fund was the largest of the TSP's funds, followed by the C fund, with the F, S, and I funds a good deal bit smaller. So tonight we're going to be focusing on the G fund, which is the largest investment fund within the TSP. It has almost $300 billion in total assets. So when thinking about who's invested in the G fund and why, we found some relatively interesting stats, or at least interesting to us. Nearly all TSP investors have some portion of their assets in the G fund, have some investments in the G fund. Further, nearly half of TSP participants have 100% of their assets in the G fund. So it's by this metric, it's the most popular or the most used of any of the TSPs, the TSP fund options available to you. Now, some history of the G fund. When the TSP was started, when it was introduced back in 1987, the G fund was the first of the investment options made available to you. It was the first fund that was created within the thrift savings plan. And an important thing to note is that it's the automatic allocation for plan participants who don't choose their investments or who don't choose their allocations. So what does this mean in practical terms? So we've run into clients, we've spoken with many clients before, who've been in the G fund their whole careers. They've been investing in the TSP, they've been putting money away. And when we ask them how they've invested their money in their 401k, in their TSP, they say, oh, well, I never changed it. I've just been in the G fund the whole time. Now, it's wonderful that those individuals have access to the TSP. It's a great retirement savings vehicle. But because of that default, those individuals have missed out on opportunities for much greater growth than they're getting in the G fund. So particularly for the clients that we speak to who are early on in their careers, if they don't realize this, it may be appropriate for them to shift their allocation rather from the G fund into something like the C, the S, or the I fund, or a combination of those, because those individuals who are younger can shoulder the volatility and can take on more risk. So this is an important thing to keep in mind. We actually had a colleague of ours spoke with a gentleman who's 28 years old, somebody really young. And we always like to joke that the people who get the most from talking to us are people who are like that, because the decisions that you can make now as a younger person can have a magnified impact over the course of an entire career. So like I said before, we work with everybody, no matter what stage of their career they're in. That was just a very topical example. But bringing it back, the G fund is the automatic allocation for plan participants within the thrift. Now, let's talk about how the G fund works. Like, what is it? So the G fund stands for the Government Securities Investment Fund. And it's the only TSP fund not exposed to market risk. It's completely safe. It has no downside risk at all. Because it's the only TSP fund that's offered that doesn't track an index. The way that your account grows, the interest that you get on that account isn't alongside an index or isn't invested in an index. Instead, you're getting an interest rate. And that interest rate that you get paid is calculated in a very special way. You can't necessarily just go onto Google and search, oh, what's the 10-year treasury rate? And know, oh, well, the 10-year treasury rate is what my G fund's gonna yield. That's not how it works. The way the G fund yield is calculated is that TSP takes the weighted average yield of approximately 153 US Treasury securities on the last day of the previous month. So they'll look at that yield for that blended group of securities, those blended Treasury securities on the last day of the previous month, and then the U.S. Treasury will issue special securities to the TSP to create that yield for them, to create the yield for the investors within the G fund. Now, as I'm sure many of you know and have experienced, interest rates have been declining over the past 30 years. And since the G fund tracks government interest rates, so too has the yield on the G fund. So this graph shows the 10-year treasury yield over time. So this is the interest rate that the federal government has to pay on 10-year government securities, so 10-year debt. Now, back in the 80s, this yield was over 10%. But since the 1980s, as aggressive monetary policy has been inducted by central banks around the world, be it the Fed here in the United States or the European Central Bank more recently, and since the 2008 financial crisis, be it the Bank of Japan, as global central banks have purchased more government securities, that's pushed down yields, and you've seen this yield curve go down over time. It's why I remember when I was a kid, my mom used to say, "Oh yeah, John, if you put your money in a bank account, you're going to get 5% per year." And I said, "Mom, how old do you think I am? You were there when I was born. I'm not. That's never been the case at any point in my life." Now I'm dating myself a little bit here, but at no point in my life have interest rates been 5% on a bank account. Whereas for my mom, that was very normal throughout her experience. So the point is that interest rates and yields have been declining over time, and since the G fund tracks those government securities, the yield on the G funds declined as well. Since 1990, the interest rate paid on the G fund has declined from almost 9% to 2020. The return on the G fund was less than 1%. Year to date, the return on the G fund is 0.4%. What that means is that if you had $1,000 invested in the G fund at the beginning of the year 2020, today that $1,000 would be worth $1,014. So while it's very, very safe and stable, it hasn't grown a heck of a lot. Very, 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 very low yields. For May, for the most recent piece of data we have, the average annual interest rate or the effective annual interest rate that you were receiving on your G fund investments, if you have any assets in the G fund, was 1.5%. Now, sometimes we speak with clients and they say, "Oh yeah, well, I saw the G fund rate was 1.5%. That means I made 1.5% on my money in the month of May." Well, that's not how it works. The interest rate is quoted on an annual basis, so it's an annual interest rate as quoted, but the amount that your investments go up is actually a monthly interest rate. So the way you calculate that is you take that 1.5%, which was the May rate, and you raise that to the 1 over 12. So it's the we're deconstructing that annual interest rate and converting that into a monthly interest rate that would be credited onto your account. So for the month of May, you're getting 0.125%. So basically a 12th of 1%. So not a whole lot of growth, obviously, but completely safe. Now, one of the things that we also hear with clients about the G fund, and it is a true nuance about it, is that it's the only TSP fund that the government can automatically borrow from when they reach a debt ceiling limit. So what does that mean? If congressional Republicans and Democrats are debating about the budget and the government is worried about or is potentially not going to be able to borrow any more money, and the government needs to source funds from which to borrow money while Congress works to raise the debt limit, the government can use the G fund as a source of funds to help finance the government. So they have to pay it back, of course, with interest. However, we do know many clients who are concerned about the fact that Congress can can borrow from the G fund, especially during times where there's a debt ceiling crisis. So understanding first, what the G fund is and then how it works, what can this mean for conservative investors? So investors who are investing conservatively uh, and want to make sure their assets are safe, what does investing in safe assets like the G fund mean for them over time and when it comes to their retirement? Well, TSP states this, and we speak about this a lot with our clients, is that just because an investment is safe doesn't mean that it is without risk. We define risk as the potential for permanent loss of capital. So while your investment might be safe and very, very stable, the idea that it's no risk might not be particularly accurate, especially if you consider inflation. Uh, this is directly from TSP.gov when they're speaking about the G fund. They say the G fund is possible that your investment will not grow enough to offset the reduction in your purchasing power that results from inflation. I know this is something that's being talked a lot about right now. This is a very pertinent topic. A lot of people are very concerned about the risk of inflation given all the spending that's happened with the response to the coronavirus. Uh, and the cost of your money not keeping up with inflation can have a really magnified impact over the course of a 20, 30, 40-year long retirement. Uh, so to understand how that inflation can affect your investments, it's first helpful to understand the difference between a nominal return and a real return. So the nominal return on your investments is the dollar value of your investments. If you look at your bank account today and it's $10,000, and then a year from now it's $11,000, your nominal return is $1,000, or you've grown 10%. The real return is the inflation adjusted value of those returns, or basically trying to control for the value of those dollars. Because if inflation is very high, well, that $10,000 you had at the beginning of that time period might have bought a lot more real goods than $11,000 a year hence if there's an inflationary environment. So, for example, just to kind of pull on this inflation concept a little bit more, pretend you had $100,000 saved and pretend that your investment, say in something safe like the G fund, was yielding 1%, but the inflation rate was 3%. So there's a 2% detriment to your growth. So over a 10-year period, your $100,000 initial investment growing at 1% would grow to $110,000 plus dollars. So you'd have nominal growth. That white line shows the nominal value of your account over that time period. However, after adjusting for inflation, the real value of your account is actually going down over that time because the inflation is eroding your purchasing power, such that at the end of that 10-year period, the real value of your initial $100,000 has actually declined almost 20%. So when people talk about the difference between nominal and real returns, and when we walk clients through this is what we're talking about, how you have to actually account for that inflation. Now, your FERS COLA, or if you're a FERS employee, your pension after age 62 has a COLA. Social Security has a COLA as well, or a cost of living adjustment that's meant to help offset the effects of inflation. With your investments, what you choose to invest in determines how well you're able to maintain your purchasing power. So, for instance, we've created this graph showing $100,000 invested in the G fund when it was first started since inception. The blue line shows the nominal value of that $100,000. So over that time period, it would have grown to nearly $500,000 from the initial investment balance. However, on an inflation adjusted basis, that $100,000 is worth barely $200,000 more. So even though you have seen some real growth over that time period, those nominal returns are much less than the real returns because of inflation. And this is something you always have to keep in mind. In fact, since 2010, since the financial crisis, since central banks in the United States, like the Fed and the European central banks, since they've been more aggressive with monetary policy and really intervened into the bond markets, there's been 10 years where the real return on the G fund was below 2%. There have been 9 years where the real return on the G fund was below 1%. And there's been 3 years, including last year, where the real return was negative. What that means is that the experienced inflation rate was actually higher than the rate of return earned on the G fund. Or said another way, the G fund did not even keep pace with inflation in 3 of the past 11 years. So, important thing to know, especially in this era of low interest rates now. So, now that we've talked about conservative investing, now let's talk about the stages of investing in the G fund. So, I know we've gone through this before in past webinars, but when we think about the financial planning process, we think of it as this accumulation, preservation, then distribution and conversion. So the accumulation stage is when you're building your assets, you're investing for a retirement or a goal in the future that's far off. The preservation stage is when you're getting closer to that retirement date, or you're closer to that date where you're going to be using that goal or harvesting that goal, and you want to make sure that wealth is available for your goal to use it. And as people get closer to that preservation stage, they tend to invest more conservatively, which makes sense that they want to make sure that that asset is available for them when they do decide to start distributing their funds and start harvesting their gains, using it for supplement to their pension or to their social security, or maybe they're spending it on a RV that they've always wanted. Whatever it is, uh, the way that the way that it's invested should be informed by when the goal is that you're trying to achieve and what the goal is that you're trying to achieve. And then all along the way, you're doing those Roth conversions like we've talked about before. Now, when it comes to the distribution stage for federal employees or federal retirees, one of the things that's really challenging is that within the thrift itself, you cannot choose which funds your distributions come from. You can say, hey, I want to pull that money out of the Roth, or hey, I want to pull that money out of the traditional, or hey, I want to pull the money out of both. But you can't say, hey, I want to take $500 a month just from my G fund allocation. The distributions that you're taking out of your TSP have to come pro rata from your across your account holdings. And that makes the TSP a more limited retirement planning vehicle, because a lot of people say, well, I want that money that's in my aggressive investments like my S fund or my C fund. I want to leave that growing. I don't want to be selling that balance down. Whereas I want to be harvesting that money out of my G fund or my F fund or my conservative investments. Well, within the thrift, you don't have the ability to choose where those withdrawals come from on a fund level. Further, there's when it comes to taking money out and taking regular distributions, there's the 4% rule. Some of you may have read about this before. There was a lot of research that was done back in the early 90s and mid 90s trying to figure out what's an efficient withdrawal amount to take from retirement accounts to supplement your income in retirement. And so that's where the 4% rule was basically saying that, oh, if you take out about 4% of your balance every year, the growth that you get on your balance should more than offset or should largely offset any of the withdrawals you're taking, such that you don't ever run out of money. That was the intent, was to figure out a efficient withdrawal rule, accounting for the fact that markets swing up and down. So when we think about that, well, first, that 4% rule works great, assuming you're getting some growth. Now, this graph here just shows the value of $300,000 if you were taking no withdrawals over a 10, 20, 30, and 40-year period. So if you have 1% growth rate, you can see that dark blue line at the bottom, it's not growing very much. If you have a 6% annual growth rate, obviously it begins to mushroom there, and it's over $300 million 40 years hence. Now, 5, 4, 3, 2, 1% growth, they fall within the middle, the middle band. There's still growth, but not as much as the 6%, obviously. Now, when you start taking withdrawals, though, these graphs really change. So assuming a $300,000 beginning balance with a $12,000 annual withdrawal, which is that 4% withdrawal rate, this splays it out. And you can see how if your account's only growing 1, 2, or 3%, you start to really whittle down your balance. If your account's growing 4%, the value remains the same. And if your account's growing 5 or 6%, it's actually compounding growth. So the growth on your investments when you're taking withdrawals can matter a whole lot, because you're actually selling down your balance. Now, what does that mean for investors in the G fund? Well, the challenging thing with that is that if you're using that rule of thumb, if you're using that 4% rule of thumb as your withdrawal rate, well, the G fund hasn't returned 4% in over a decade. So your withdrawals that you're taking if you're using that 4% rule, are more than the investment gains that you're getting if you're in a conservative allocation. So it's not making up for it. So the question that we often get asked is, what are different alternatives that are available? What can we do? So you could look at things like a high interest savings account or a certificate of deposit. You could look at bond laddering strategies. You could look at fixed income bond ETFs and mutual funds, and we do find many people who look at those strategies. You could also look at fixed index annuities, where in exchange for some liquidity restrictions, you could get downside protection, but also have some growth. It just depends on what your particular goals are. One of the things that we often talk about with our clients is that you want to make sure that you're not selling down your balance inefficiently. You want to make sure that the money that you have set aside is that way for a particular reason. We also think of things in terms of a trade-off, the sort of the growth, liquidity, and safety. And the closer you get to one, the further you get from the others. And it's a question of balancing which ones make the most sense for you, be it, hey, I need the money really liquid. Hey, I really don't care about the risk. I want to have a lot of growth. Or, hey, I need to preserve these assets for the long run, or figuring out what the best trade-off is between those. So, the most efficient place to put that and the best way to position yourself depends on your specific goals. For clients that say, hey, I just want to leave this money behind for my grandkids, that's money that should be invested very differently than if you say, hey, I want to use that money next year to buy a boat. If you say, hey, I need to live off of an extra $400 or $500 per month for the rest of my life, in addition to my pension and my Social Security, well, the way we'd invest it is, or recommend that be invested, is different as well. These things all have lots of moving parts, and it's all about finding the most efficient vehicle, the most efficient place to achieve the goals that you want to achieve. And that's something we at Parco help our clients with every single day. We actually just grew our team by another person this week because we have so many people that are trying to reach out to get help from us. So attached is a copy of our works cited tonight. As always, we always like to make sure you know that that's available to you. In terms of some upcoming webinar topics that we have, one that's been really asked about recently is required minimum distributions and RMDs. We find a lot of people are worried or confused about how RMDs work, so we wanted to do a whole webinar covering that concept and topic. So we're looking forward to seeing a lot of you on that. And then we'll be covering the transition from federal or from veteran to federal civilian. Over 30% of the federal workforce is a veteran or are veterans. So we want to talk about that. And then down the line, we'll be covering disability retirement and the retirement paperwork process, along with hopefully some great topics that you all suggest to us. If anybody needs to reach out to us, our website's goparco.com. You can email us at info@goparco or reach us on our main line, 833-GO-PARCO. A human does answer that line. We'll stay around to answer all your questions. I did see some questions come in during the course of the webinar, so we're happy to answer any of those. And as always, it was a delight to see you all.